Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today we're discussing how to avoid constructive dividends on shareholder loans. Shareholders of closely held corporations often have the problem of deciding how to get the profits out of a corporation without paying taxes on the distribution. This is because generally, transfers of cash or property from a corporation to its shareholders are treated as dividends and are taxable to the shareholders as income. Some shareholders would like to treat these distributions as loan repayments, since that's one way to avoid double taxation of the income. The IRS, in response, has developed rules for defining what is a bona fide shareholder loan. If the IRS, under audit, determines that a distribution is not actually a bona fide loan repayment, it will reclassify the payment as a taxable distribution called a constructive dividend. To avoid this, the shareholders should create a valid loan agreement, which is written, signed by both parties, and notarized, recorded as a loan in the board meeting minutes, and calls for required loan repayments at regular intervals with a reasonable stated interest rate, and has a stated maturity date that is not open-ended. The terms of the agreement should be reasonable and done at arm's length, in other words, should be similar to other terms available to the corporation on the open market. The amount of the loan should be limited based on the corporation's credit, and the corporation should be able to afford to make the loan repayments based on its earnings. It's also helpful to have the loan backed up by collateral, such as equipment, a vehicle, or accounts receivable. With respect to the loan repayments, they should be made in fixed dollar amounts on time according to a loan amortization schedule that's created at the beginning of the loan. Interest expense should be recorded on the corporation's books and deducted on the corporation's tax returns. Interest income should be reported on the shareholder's tax return. Form 1099 INT should be issued if required, and any loan payments or balance should not be forgiven by the shareholder lender. For example, a shareholder lends his corporation $50,000 in June of 2010 to help fund operations. The corporation must pay 3% interest for 5 years according to the terms of the loan. All other terms are consistent with other loans the corporation has with its bank. The corporation will pay $10,918 per year to the shareholder, and the loan will be paid off in June of 2015, as you can see from the loan amortization schedule on the screen. The corporation will show the loan balance in the right-hand column in red on its balance sheet for tax years 2010 to 2015, and will deduct as an interest expense the amount in the blue column on the screen each year on its tax returns. The shareholder will report the same amount as interest income on his tax return each year. The corporation will file Form 1099 INT with the IRS and give a copy to the shareholder each year. Assuming the corporation and shareholder are consistent in treating these payments as a loan, the IRS will have no basis for treating them as constructive dividends, and the shareholder will save a lot of money on his tax return. If you have questions about this video or other tax or accounting topics, give the tax experts at AA Accounting a call. Call us today to schedule an appointment to discuss your situation. We're here year-round to assist you and look forward to hearing from you.